For now, let's talk more about today's rally with our market panel. Joining us now is Anastasia Amoroso of iCapital and Sameer Samana of Wells Fargo Investment Institute. Guys, welcome. Anastasia, do you trust today's rally? You feel better about tech and energy than about consumer discretionary. Why?
I don't quite trust it, John, because I do think some of the fundamentals are starting to change. But let's talk about different time horizons. Let's just talk about this week and maybe into year end, and then 2024 is a separate story. I do think, as Mike pointed out, coming into this week, we did hit some oversold levels. We've got a lot of the community, systematic community, hedge fund community that did de-risk coming into this week. So the positioning slate is a lot cleaner. And of course, as you also mentioned, we are now sort of in the back half of the earnings season, which means more corporate buybacks are likely to come back. So I think mechanically, we can justify a case for some sort of a bounce back here. The other thing that I'm looking for this week is the Fed. And I actually expect that that might be a bullish development because Fed Chair Powell sort of alluded to the case that, the fact that Treasury yields rose across the curve means they might be done tightening. I think he might reiterate that. I mean, how much the Treasury yield curve has steepened out and how much the back end of the curve has risen, that is a lot of tightening that the economy has to digest. So I think that doesn't count for only one, but possibly 3 rate hikes. So I think if the Fed delivers that sort of message, that could be a near-term bullish catalyst for the markets.
And Sameer, you still see downside risk in stocks. Think we're going to test the recent lows. What's going to trigger that test, you think?
Yeah, I mean, look, the tricky part for markets right now is you've got, rates still kind of, testing the upper limits of kind of the upside. The fact that we're all watching a Treasury, announcement about whether they're going to issue bills, notes, and bonds, I think is very telling. Not sure the last time that played such a big role. And so I think that bond volatility is probably still the biggest driver for stock market volatility. And then look, a 10% pullback doesn't solve for the fact that we still see a recession, unfolding very late this year, and it'll probably occupy markets for much of next year. And so, it's, I guess, good that valuations have maybe gotten a little bit less expensive, which is really where we were for much of the summer, but it still doesn't change the macro.
I just want to go back to something you said, Anastasia. If I heard you correctly, it sounded like you said what we've seen, the financial markets tightening, what we've seen in the bond market has been the equivalent of 3 additional Fed rate hikes. If that's the case,
yeah.
Okay.
Yeah.
If that's
go ahead, Morgan.
If that's the case, has the equity market fully digested that? And just as importantly, then, do you like bonds over stocks, or are you suggesting something else entirely?
Yeah, I think more in near term, the equity markets have repriced for the spike higher in yields, and we're seeing some stalling out in Treasury yields as well as the sell-off in equity markets. But I go back to a different time horizon. If we think about 2024, if yields high for longer are here to stay, it is going to become even more incrementally difficult to refinance the debt that is coming due. In 2023, we had to worry about what's floating rate and how is it adjusting. And the reality is not that much of the U.S. economy is floating rate. You've got some leverage loans, you've got some pockets of consumer, but on balance, it's not that much. What we have to worry about next year is fixed rate debt that has to be refinanced at much higher rates. And whether you look at corporates, whether you look at banks, whether you look at the U.S. Treasury, all of those stakeholders are going to be borrowing more and going to be borrowing at higher rates. So I do worry, and I am sympathetic to the view of the other panelists, that we might be heading closer to a hard landing scenario the longer the rates stay where they are. So with all of that in mind, you have to have a trading view and you have to have sort of a broader asset allocation view. And what I would tell you about how we're thinking about portfolios today, it's really going back to, well, first of all, cash now pays something. So money markets is a viable option, is a viable alternative. It's short duration fixed income. I wouldn't really take long duration risk. It is things like investment grade corporates. I don't love treasuries, but I think investment grade corporates and municipal bonds, that's a better risk to take. And then private credit, where you can earn close to 12% yield right now.